Welcome to Total Convexity, a weekly financial podcast that caters to professional finance individuals, high net worth investors, family offices, and other sophisticated financial professionals. Join our hosts, hedge fund manager Jim Wang and Henrik Neuhaus, as they explore the interconnected world of global macroeconomics, central banks, and capital markets. Comprehending the intricate web of global macroeconomics, central bank policies, and capital markets isn't just an option, it's a necessity. Whether you're a chief investment officer, financial analyst, entrepreneur, or simply someone curious about how the global economy and capital markets function, this podcast serves as your compass through the intricacies of the global financial landscape. In each episode, we will delve deep into the influential factors shaping our world, from global economic trends and central bank policies to capital markets and trading strategies. We will demystify financial jargon, clarify complex numerical data, and provide you with insights from experts in the field.
I'm your host, Henrik Neuhaus, and this 8th episode of Total Convexity is being recorded on November the 21st, 2023. Joining me is my co-host, Jim Wang. I'm glad to return with this 8th episode of our podcast series. In the first episode, we discussed our investment and analytical framework, and we recommend new listeners to start out by reviewing our first episode, as the explanation of our framework lays the foundation for later episodes. Since then, we have discussed interest rates, the US dollar cycle, gold, fiscal and monetary policies, liquidity, and most recently, we discussed the correlation between stocks and bonds. Jim, as 2023 is inching towards its end, I think it may be useful to discuss your market outlook for next year. What do you think 2024 will give us? Jim?
Hello, everyone. I'm glad to return to this new episode. Henrik, I think that's a good idea, probably a good time to tie everything that we have discussed together. And I hate to discuss calendar-based outlook because we do not tie our horizons and outlook to calendar. And our views are dynamic, and we do not have a deterministic views on the market. And our views always evolve based on how the underlying forces change. And therefore, I hesitate to give an outlook for the entire year, and definitely not that year-end target, which I think is not useful. However, I think it's good to lay out our current thinking based on the information that is available to us and how that can evolve if the underlying driving forces change. What do you think, Henrik?
Okay, sounds good. Before we start, just a little housekeeping note. So this podcast is a combination of this week's and last week's, and we will return again with our next episode after Thanksgiving, the first week of December. So, Jim, why don't you share with us your 30,000-foot big picture views? Jim?
Yeah, sure. So I think we will talk about different time horizons, and I'm just summarizing here because a lot of them we have discussed them, and so it will sound redundant to deep dive into the details. First, we think that we probably at the the beginning or the second episode of the long-term inflationary cycle turning to the upside, and the last one that we saw was in the 1970s. And we think that the deflationary forces in the past 40 decades probably is coming to an end, and then we will have a higher inflationary time period in the future. Doesn't mean that this is for sure, but the underlying drivers point towards that direction. And embedded with, so I think that's the longer term views. Then we have a 5 and 10 year kind of a market economic cycles. And that's the market cycle that we're familiar with. I think we are coming towards to the end of the market cycle. If you consider pandemic as an kind of an outlier, external kind of exogenous shock, then I would say this is mark the end of the market cycle that started from the Great Recessions in 2009. And so that's, kind of 5 to 10 year kind of market cycle views, right? And I think we're towards the end of it. Now, if we narrow down towards that, the end of the cycle can last for a few years. And based on our readings, we think that the recession could be imminent. That could happen as soon as in the next few months and quarters. So that's kind of a very brief summary, and you tell me, what direction that you want me to go.
Right. Well, this is interesting because for some time, for a while, since say 2021, many people have said that a recession will be upon us soon. But by now, most have given up on on this hypothesis. So, and the prevailing narrative now is one of a soft landing. Inflation has come down, and the Fed is probably close to the end of its hiking cycle, something which presumably should be good for both the economy and the markets. You, Jim, however, are sticking to your guns. Could you please explain to us why you believe that a recession could be imminent, Jim?
Yeah, Henry. So I would say, the reason why in 2021 a lot of people think a recession could be imminent, primarily because of two things, right? One is I think that the stock have a significant decline. And that's the first thing. And the second thing here is that, a lot of leading indicators people were watching already turned down big time. And now people turn around, ironically, is I think, at the time that where the probability for recession to happen is a lot higher than before, is because the asset prices come back, right? And at the same time, people have been waiting for this for a long time, and it looks like economy is still very resilient, right? And if we look back in the history, what we have experienced is nothing more than normal. It's very normal. It's typically when the Fed hike interest rate, stock kind of have a drop, but not so significantly because typically the rate hike was slow, the P adjustment was slow, plus economy was still growing, and once the Fed hike for a period of time and then pause, and then that's typically we have a monetary tightening. Already work in the economy for quite some time. That can range 12 months, 24 months, and then Fed start to cut interest rate right on the time that the recession kick in, right? So if we follow this timeline, we are not, far away from that. But we are just not following this simple kind of analog like a lot of people say, right? We look at the underlying kind of the cause and the underlying forces of the cause and effect, right? The tightening monetary conditions is not something that is just a theoretical theory. So what we are watching here is we watch a number of leading economic indicators. What are they? And they have a long lag. They have long as leading indicators. I mean, they have a long lead. They lead, right? So the lead time really varies, right? Then we look at coincidental data to see what is happening, right? I would say if we look at our leading indicators, typically construct a lot of them start with the financial conditions, right? Say, for example, the change of the investment grade or the grade bond, right? And we look at a change of the magnitude of the yield. We change the mortgage spread because that is kind of the market. We see what's the size of the jump, right? When we see a big size of the jump, based on our historical kind of models, and then we say that likely going to have impact on the economy. And what's the impact? I mean, typically started with housing. Now there we also follow a sequence. We follow the housing permit, right? And then the start, right? Because that directly have impact on the construction workers, right? And all the whole things that are associated with housing. When people buy houses, there's a whole thing go with it, right? Remodelings and also the gadget, home appliances and all these things. So the housing is an important component of it. And in the past, when housing price was going higher, interest rate was not that high, people actually were able to take money out, um, you know, um, home equity loans and etc. Those are all stimulative, right? So housing is an important component. And then you look at auto and you see, what's happening in the auto industry, the sales has come down significantly. The secondhand, cars price has collapsed. And obviously, there's still a little of supply constraints. New car sales, price seems to continue to be supported, right? And then because all the Fed tightening go through the credit, channel, right? So you want to see the bank is tightening lending standard, which they have, right? And historically, when they reach to that level, it coincided with the recession. And then you see the demand for the loan has come down, right? So if you look at a survey, there's a slew survey, a lot of people talking about, which they have, right? And then we also look at, a lot, I think, industry, we all focus on ISM for the right reasons, right? Because these survey typically lead as well. I think one thing that is unusual about this time is that because of pandemic, that's distorted a little bit of sequence, right? In the past, typically, when you see manufacturing going down like this, when you see the global, trade going down like this, and typically we are at the verge of a recession, and the service will follow. And this time I think there's something different because of this pandemic. So I think during pandemic time, people cannot travel, so they bought a lot of things, and because of supply constraints, so there's a lack of inventory, right? So the manufacturers, store sellers, they try to build up a big inventory just in time for the reopening. However, after reopening, people start to pick up a more kind of consumption in the services area, right? So I think you see the big kind of drop of order to the inventory, right? And once that inventory is working out, you have another kind of restocking, and which we see help to boost up economy a little bit. So I think there's something going on there. But if you look at a general trend, I think the ISM and is poised to rolling down for the manufacturing, and the services turning down as well. So if you look at all these things, and then I think once we're moving ahead, I think kind of a recession watching is is a very difficult game, as you see. I think getting time right is actually more important than getting the view right, because we, as a financial, as we in the market, we do not live in the eventuality. We cannot say eventually this is going to happen. We actually do need to pinpoint when it's about to happen. And we watch a number of this kind of data does not guarantee things is going to happen, but it's almost like you're driving your cars, or maybe your airplanes, right? And you have different kind of signals and indicators, and showing you some of the dangers ahead. It doesn't mean it will occur, but it gives you cautions, right? Now we actually see that we are inching towards closer to that, and that is more employment. So we have expecting softness in the employment, in the labor market. We are actually very surprised for the resilience of it, and obviously I think we agree with a lot of pundits' assessment is that because it was so hard to hire people during the pandemic. So there is a labor hoarding mentality of a lot of employers, even in face of the some of the difficulties, they do not want to let people go. But we see, we have seen before people, kind of fire the full-time job, they typically will cut down the hours worked, and they will cut down the part-time, workers and etc. And those typically lead, right? And we have seen that. And in the most recently, we actually see the unemployment rate start to tick up. and it's actually higher than the historical 6 months moving average. And historically, when that happens, and we would be entering recession. I'm not saying that this for sure is going to happen. I'm just saying, historically, this point towards to the economic weakness, not the other way around. Similarly, we see continuous, jobless claim is perking up. It looks like it's going to start to go higher. And typically, once the continuous jobless claim go higher, that basically indicates people who lose the job, was not able to find job quickly, and that's why the continuous claim are climbing. And the initial jobless claim also show, signs picking up. These are the, most real-time job as much, as much real time as you can get, because this is the weekly kind of released data. And obviously, we watch them closely, and I think it doesn't mean we are not draw conclusion here is, for sure, right? Nothing is for sure, but we are watching the incoming data, either confirming or negating our views that the recession actually could be imminent. Another one, I think this is, I think this is a very good episode to tie everything together, because we do mention that we have some market-based indicators, right? Our market-based indicators, that there's two types. One type is more kind of a reversal, and that's a long-term kind of indicators looking at things at the extreme, and we were approaching the historical extreme and poised to reverse. And the other one is, it's also reversal. Is on the historical extreme, but it's reversing. And we talk about that historically when that happens, and it points toward recession. That is the bull steepening of the curve. So when the 2 years start to roll over to the downside, 2-year yield, meaning the yield peak, and then start to roll over to the downside, which is our base case. And by the way, if the price action change, we change. But so far, our base case here is the 2 years rate has peaked. And if you look at the curve, we also think the curve having kind of consolidating in the inversion kind of area for quite some period of time. Now we think that the steepening is going to continue. So historically, when that happens, typically is the recession. Why? Because people anticipate the Fed would cut interest rate in terms, during the facing of the economic weakness, right? And short rates fall faster than the long rates. So we are watching that closely. Obviously, this is still at the very beginning, and all these things can reverse. So we can, like I said at the very beginning, we do not have a deterministic views. Our views will change, but based on all this, it points to, recession could happen very soon.
Okay. Now, before we get to your outlook for the different asset classes, could you just say a few words about liquidity? I mean, we discussed liquidity in the past, but how do you think liquidity will impact the pricing in the asset markets in the immediate future?
Right. And Henrik, that's very important, because the economy does not equal to the capital market. They are very different. They are just one of the variables, one of the factors. And they have more impact on rates because of the reaction function of the central bank. And the equities have different factors that influence that, right? But among all the factors, liquidity is the most important factors that impact all the asset classes, like we have mentioned before, especially the financial asset like equity and bond. And the economic development, they actually just impact on the distribution of the pressure of the liquidity of different asset classes. Okay. So if we look at the liquidities, and I would say the general picture for the liquidity has been tightening because of the big issues of treasury bond and also Fed QTs, right? But this liquidity picture, this is not linear, right? And we have to navigate through this, and it's not easy. Once you look back, you see, oh, this happened and that happened. You can explain that. But rather, I think it's more useful is look forward into the future and see how that can change. What we can see here is because of the QR, we discussed this in one of our episodes about the QRAs, liquidity. So listeners can listen to the update on the liquidity, where basically the Treasury, Janet Yellen, has chosen to issue more debt via T-bills, okay, rather than coupon bond. And that alleviate the liquidity pressure. Also, we talked about there was more than 2 trillion of the reverse repo, which is money of the money market funds parked at the Federal Reserve. Okay, when the money is at the Federal Reserve, and that is not entering financial system, and hence that is not positive for liquidity. When it leaves the Federal Reserve system and entering the financial market, that is positive for liquidity. So in the past, five months, right? We basically have seen a significant decline of the reverse repo. Now we have about $1 trillion. Our estimate is that this decline of the reverse repo is about 200 billion per month. So we are in the middle of it. I would say in the next few months, right, it will drop to in 4 months, right, it will goes down to 200 billion, right, around that. That continue to support the market, okay. And so I would say the liquidity picture in general was tight in tight, but in the near future, because of the QIA Treasury maneuvering of the coupon issuance, and also the depletion of the reverse repo, the liquidity actually was supported. So I think the asset prices can actually support it during this time period of time. Beyond that, I would say liquidity picture will start to tighten pretty quickly once we drain this reverse repo facility.
Okay. So, okay, now tell us what you think about the different major asset classes going forward.
Yeah. So let's start with the rates, and I always start with the front rates of the Federal Reserve, kind of a policy. It doesn't mean that I can handicap the next policy, meeting, which I think is not important in any way. In my view, I think we probably have reached the terminal, kind of a rate. So essentially, Fed has been pausing interest rate hike for quite some time, right? If they do not hike December, and that's probably is the end, we have reached the end of hiking cycle already. I do think the possibility for them to hike in December has diminished significantly because of recent inflation data and employment data. Obviously that can also change, because I think one of the reasons that they did not hike last time is because the rise of the long rates and the decline of the stock market was doing the job, tightening job for them. Now all that have been reversed. So we have a significant decline of the bond yield. We have big rally of the stock price. Financial condition has been easing. So I think the Fed is facing relatively easing financial conditions at the same time that underlying data it's it was pretty start to show pretty weak. I think facing these options, and I would say that the probability to hike is have already significantly diminished. But one cannot rule out whether they have a final hike because of the financial conditions, which I do not think is the probability is high, but it can happen. But in either case, I think that if that happens, I think probably it's the last hike anyway. If we are right about the economic projections. So in the end, it's not what the Fed, will do, want to do. They do not have a kind of a determined, predetermined kind of a plan in their mind. Rather, they are following the data, following the data as they see. So So I think if I'm right about this, I think the short rates 2 years, may fluctuate a little bit, but I think it's we probably have already peaked out. Um, and um, uh, and uh, and uh, and if the economic data continue to be weak, if our readings about the projection of the inflation coming down, economic slowing, then I think interest rate may have already peaked during this cycle across the curve, and the curve may start to steepen. So in this case, I think the 2024 Treasury probably will have will perform much better than the other asset classes. And if you look at the relative valuations between Treasury and equity, the risk premium for the equity is very high, right? So then we can talk about the stocks, right? That's, so the stocks right now, I mean, the forward earnings price for the earnings to grow, 10 to 15%, right? And that is basically pricing reacceleration of economic growth, right? And I would say if we have a soft landing, right, like zero earnings growth, I mean they're still overpriced by 10%, right? And if we have recession where earnings can decline average 20%, and that means that by adjusting earnings, right, stock can go down 30%. And if you adjust the risk premium, and that will give you another 10 to 20% of decline. So I would say it's not unimaginable for stock to drop by 25 to 50% during the recession, given the valuation and situation that they were facing right now. And then what else? So currency, we talked about this in the past as well. And typically the US dollars will start to weaken once people realize that the Fed has arrived at the end of the hiking cycle, right? But during the risk-off situation, dollar will return to be safe haven, right? So we talk about the dollar smile. Typically, dollar is weak. Dollar is strong during two scenarios. One is the U.S. economy really accelerate and outperforming the rest of the world at a significant margin, right? And during that time, dollar will rally. I would say we have seen this in the past, since 2021. And then the second, another tail is like during the deep risk off, right? And dollar will rally. And during the other moderate economic scenario in between, dollar will be soft, right? So that's why we have a dollar smile, this word, to describing this, right? So I think the U.S. dollar, may weaken a little bit more, but I do not think it will significantly weaken from here, because I see there's not much divergent kind of trend here to argue the rest of the world is actually doing better than the United States, supporting this thesis. So I would say it's more kind of U.S. catching up with the rest of the world, is slowing down, therefore reversing the stronger trend of the U.S. dollars. And if I'm right about the recession and the asset class decline, I think at a certain point the U.S. dollar will start to strengthen. Similar story can be said for gold. We talk about, there's other component for factors for gold, but from the monetary policy perspective, gold typically will start to rally once the hiking cycle, once it anticipates the end of the hiking cycle, which I think is already happening. But if there's a liquidity event, and especially after gold has rallied significantly higher level, then gold is prone to be liquidated when there is a big decline of the asset prices and the deflationary shock. So I think that can happen in the middle of the year. Sometime, if if the hard landing scenario materialize, and we have to watch how that. In terms of industrial commodities, and obviously there's a supply and a demand, and I would say the grain agriculture sector is very idiosyncratic than the rest of them, simply because it's impacted more by weathers and those other things, right? But if you look at industrial commodities like oils and coppers and etc., I would say from demand perspective, they will probably be weak, right? If our outlook, prove to be right. And obviously there could be a supply shock more, from oil perspective if there's a geopolitical escalation and tensions, etc. But that tends to be short-lived. In addition, I think at this point of cycle, any spike of commodity price due to geopolitical intention actually is not inflationary. It could be deflationary because this is from the supply shock, and it already created more constraints, more strains for people spending, as they are already pretty tight. So the higher commodity price will constrain people spending in the other areas. And I would say, from the, can the commodity have price have go higher? Sure. But from the intermediary cycle perspective, this is not time to be super bullish on commodities. Now, I think we talk about these kind of views. Just remember, this is about cyclical views, right? To play out. If I look at the very short term, like I said, I think the liquidity could continue to be supportive in the very near term. At the same time, I think the equity market people were pretty optimistic because the econ data haven't fallen out of bed yet, right? And at the same time, people think that the Fed is going to not only pause but cut interest rate. And I think from positioning perspective, it also rallied back from very oversold levels, and also this is the end of year seasonality, right? And presidential election cycle typically during this time is bullish, right? You can tie all these things together. The very short term, I mean, things happens every day, but I would say in the very near term, I think it's close to the exhausting point in the next few days. Probably will pull back, right? And then I think it can rally into the beginning of the year, and even sometime beginning of the year. And then I think you need to be very cautious when after that. Obviously, we can change our views in between if we see something different, but this is what we are seeing at this particular point of time.
Okay, thanks. This was a very comprehensive overview, and a bit of a contrarian take on the markets. So talking about being a contrarian, I think that you have two special cases, two idiosyncratic opportunities that you are thinking about them. Could you expand on that, please?
Yes. So basically, the financial assets are highly correlated, right? Especially the risk asset, right? And that's why diversification within the same asset classes, offer you less benefit. However, from time to time, there are some sub-asset classes where their correlations are very different than the rest of the market. At a certain time, it doesn't mean they are always the case. I would think one is Argentina and the other is China. So in both cases, I think we require, for each topic, require a separate kind of a podcast for us to discuss them. But very, very briefly, we can touch upon this, right now, is that basically is the election of Argentina, we think is a game changer. And the problem for Argentina is a classic problem of MMT, meaning meaning that in order to buy the vote, you promise people a lot. In order to stay in power, you promise people a lot, and you spend all the money. And because you do not have all the money to do the spending, and by the way, all those money, when you spend it by the government, and they can only create a short-term impulse. It will be gone once the stimulus is gone. In order to keep the growth, you have to spend more and more and more in order to keep the growth momentum. And because of your spending is not productive, and that will result into inflation, because the amount of spending, people's spending power increased. However, the amount of the goods and services are constrained. You do not create an amount of goods and services because of lack of productivity. Now, if this happened, if the United States were emerging market country, if dollar were not reserve currency, and the U.S. dollar, United States will be next to Argentina, right? But U.S. dollar, U.S. is the reserve currency, and the U.S. dollar is different than any other time. This can buy the United States time. Versus the other emerging market, the consequence for them is immediate, right? So, and that's why Argentina have a high inflation and the poverty. And Argentina used to be the richest countries, one of the richest countries in the world. In the past, people see as rich as Argentina, right? And Buenos Aires used to be called the Paris of the South in the 1930s. And I would say the Milei, right? And he is a radical right, right? So he want to stop this, right? And want to tie currency to the U.S. dollars, reduce the footprint of the government, and reduce the government spending and all this, right? And I won't say this is going to be easy. This is going to be extremely difficult to change. And you and I can dig a lot into the details of this because we do not have time to cover the whole thing. And in addition, his party only have 15% of the seats of the Congress, right? And how hard he can push through things is a question mark. But I do think it reflects the mentality of the people in Argentina, right? And it's probably just a beginning. And I think any positive changes in a country that has been in such a misery for some part of time will be a relief. So I consider this is a very long-term kind of story and to play out. Obviously, we can never underestimate how politicians can mess up things, right? So and this has happened. The hope has kindled before and died right in front of our eyes before, right? So we know for sure. We do not know for sure, but I think this is a very positive kind of development. The other one is China, right? And I think China will not the Chinese asset may not correlate too much to the United States and the rest of the world. It's because I think the Chinese cycle is kind of decoupled from the rest of the world because of this recent kind of supply chain things, the trade wars and all this. And if you look at kind of monetary policies there, China is easing monetary policy, easing the fiscal policy, and the rest of the world is tightening, right? China is the major economy that is easing. So if you look at our framework that we're using, fiscal and monetary policy, and that's positive for both economy and also for particularly positive for the asset prices. And another reason is that the positioning has been washed out, and I think it's very contrarian in the sense nobody want to invest in China. China has been called uninvestable for 2 years now, and I think any positive, so therefore when you have this very underpositioned the market, it tends to be less correlated to the global market, and the Chinese liquidity cycle is not correlated to the global market, and therefore I think the Chinese asset will be uncorrelated to the global market, and based on our readings, we think, and also obviously we can talk about the valuations. Chinese, stocks valuation is very cheap. I think if China have continued to have economic weakness, which is already in the price, it's more kind of a geopolitical discount for the Chinese asset. I would say there is always permanent discount. I do not think that this discount will be reversed. I think there will be always discount, but it's just depending how deep is the discount, and whether this discount will become less or more. In other words, the discount, the kind of the direction of this, right? So if I look at the recent kind of relationship between the U.S. and China, I think both sides want to basically ease the tension a little bit. I do not think that they will return to the same kind of a good relationship they have before. And if anything, I think in the long run, they will deteriorate further. However, in the short run, and meaning 1 year, 2 years horizon, I do think they are trying to avoid the relationship fall off. Taiwan also is, going to have an election, and depending on the election result, the tension between China and between China and Taiwan, the mainland and Taiwan, the relationship could improve, and that will ease the geopolitical premium as well. So if I'm thinking all this together, I do see short-term catalyst for the re-rating of the Chinese asset. Now, having said that, from the longer term, I'm hesitating to be bullish on Chinese asset. Mainly it's because several things, but I think the most important thing here is that I think what have helped Chinese economy and also help Chinese economy is really the market-based economies that they have been doing. Looks like they have reversed that. And if this trend continue, then I do not think it's going to be good, right? And obviously, if it reverse back to more market-based economy, then I will be more bullish again. From the there is a structure issues, people discussing about aging populations, and also the housing. Burst of a housing bubble, the housing sector, which I do acknowledge that they are a burden and they are a problem and the structural reasons. And by the way, we have pointed this out. I would say quite some time ago, 7 or 8 years ago, right? Anticipate these things. But on the other side, we do not think there will be financial crisis there. As a matter of fact, we think that the burst of housing bubble, if handled properly, can redirect the capital into more productive sectors, because we do not think the housing sector is the productive sectors for the capitals. And if anything, it constrains consumer spending and prevent them from, transition from fixed asset economy into consumption economy. So, what I'm trying to say. What I'm trying to say here is I think from the short term in the next 3 to, I don't know, maybe it can last 10 months, 12 months. I do not know how long this can last. And but I see a good chance, right, that the Chinese asset may have a re-rating. In the long run, I am not that optimistic because of the structural reasons that I talk about. That I mentioned before.
Okay, thank you. So let's return to your high-level outlook for the economy and asset prices. What could make you revise your opinion? What are the particular risks to which your outlook is exposed, Jim?
Right. So I think our underlying, if you look at our underlying drivers, and typically these are monetary policy, fiscal policies, and liquidities, right? If anything of this changes, and then we will change. From the monetary policy perspective, all right, say, let's say, if the Fed tomorrow just say, cut interest rate by a few hundred basis points and start QE, and obviously we'll change our view, and this is going to be different. And or if the administration announced $1 trillion of fiscal stimulus, right? I'm just exaggerating. I'm just saying, give you a sense that if things change, then we have to change. And we want to, obviously you need to see how big it is, how long is it going to last, whether this can last a long time or maybe a few quarters, a few months, etc. Right? So, and also liquidities, right? We discussed that as well. We have some anticipations, but a lot of time, I would say last year, a lot of things happened that is, completely unexpected, and we only know that once they announce, right? And then we have to adjust. But from the monetary policy perspective, I think for the Fed to proactively ease, probability is very low. I think, can the Fed cut the interest rate and do the QE? Yes, they will do that once the stock goes down 20, 30, 40%, and we're in recession. Yes, they will do that, but not before that, right? And then for the fiscal policy, I mean, that is a bigger uncertainty. I would say that, this is already unusual time last year when the inflation was running high like this, right? And you have Bidenomic fiscal stimulus at the same time. Fed was the tightening financial conditions, right? And we discussed this. We discussed this situation during our fiscal and monetary policy discussion. That episode, I think listeners can listen to that. And this is the election year. We are coming up with the election year in 2024. If at the beginning of next year we have a big decline of stock prices and a big uptick of unemployment rate, will Biden try? Will the administration try to do something? I think they will try. Will they be successful? I doubt, because of the current, political situation and the Congress makeup, right? But we will watch that, and as time goes, right? And if the recession doesn't come sooner, and just keep linking around, and then the election risk start to emerge, sometime later in 2024, and if Trump is leading the poll, and obviously his policy is going to pro spending, and so you can expect big fiscal stimulus coming out of that. At the same time, he probably want the stock price to go higher. How to do that? You cannot have higher rates, so you probably will pressure the Federal Reserve as well. So you basically have, you already, the MMT is already emerging, right? As soon as his polls start to lead. Well, how fast that will be priced in the market, how that is going against the predominant trend, which is still in place, is that tightened monetary policy and the fading fiscal policy is resulting, is putting the pressure for the financial asset and also economy, versus the anticipation of potentially, Trump win with the fiscal policy and largely monetized by the central bank again, and how fast that will start to be priced in. And I would say that's the biggest uncertainty, which we do not have an answer right now. We have to, navigate through that thought process, and going through that and looking at. But we certainly keep that in mind. And obviously, all the geopolitical things that will impact our discussion about the U.S. and China, the commodity price, and etc. So that's something that we have some visibility, but we cannot. But we have, it's very foggy. Let's put it this way.
Okay, thank you. Well, I think we have now come to the end of episode 8 of Total Convexity. So let me try and summarize. Now, Jim, you believe that we're inching towards the end of the current market cycle, and based on our indicators, a recession could be imminent. You also argue that if events unravel as we are expecting them to do, we have probably reached the terminal rate of the current hiking cycle. In this environment, you believe that U.S. rates and Treasury securities present the best risk-reward trade-off. You also think there is an elevated risk for equity to experience a significant drawdown next year, and you expect the correlation between stocks and bonds to return to be negative. Typically, the dollar rallies once the Fed pauses rate hikes. However, you think that the US dollar is poised to rally during a risk-off environment. Finally, gold also typically rallies once the Fed stops hiking rates. However, gold may suffer if there is a liquidity squeeze in the financial markets. Given your outlook for a recession, you think there is more downside than upside for industrial commodities, but the geopolitical situation can have a short-term impact on both gold and oil prices. You will change your views if the underlying macro forces change, because the policymakers can extend or shorten the expected downturn. You believe that the Fed is unlikely going to ease in the absence of a recession or material asset price declines. 2024 is an election year, as we all know, and you will be watching the fiscal response closely. The fiscal situation could become highly uncertain, depending on who ultimately becomes the next US president, and this is something that we will discuss in a separate episode. Was this a fair summary, Jim?
That's a very good summary, Henrik. So let's end here and tell us where listeners can follow us.
Okay, so you can follow us by searching for Total Convexity in your favorite podcast apps or via YouTube. And don't forget to click on the subscription button so that you will be automatically notified when the new episode is available. You can also follow us on X, where we have the handle @TotalConvexity. And you can email us at totalconvexity@gmail.com. Finally, you can follow our insights on Substack, and that would be totalconvexity.substack.com. We promise never to spam you or to provide any type of advertising or marketing. And the only thing that we'll do is to try and give you our honest take on the markets. We'll be right, we'll be wrong, but we'll try and make it short and sweet. Anything else, Jim? Oh, by the way, happy Thanksgiving to everyone.
That's right. Yeah, so thank you, everyone, and happy Thanksgiving. If you like this podcast, we would appreciate if you can pass along to anyone who may be interested. And this concludes the 8th episode of our podcast, Total Convexity. See you next time.
Disclaimer. The information provided in this podcast is for general informational purposes only and should not be considered as financial advice. Consult with a qualified financial professional before making any financial decisions. All investments involve risks. There are no guarantees of profits, and investments may incur losses. The contents discussed in this podcast is not a recommendation for any specific investment. Past performance does not predict future results. The opinions expressed by guests on this podcast are their own and may not necessarily reflect the views of the hosts or affiliated parties. The podcast host and guests may have financial interests in companies or products discussed, and listeners should be aware that the opinions expressed by guests and their hosts may reflect biases. We strive for accuracy, but financial information can change rapidly. The content may not always be up to date or complete, so verify information independently. This podcast does not offer legal or regulatory advice, and listeners are responsible for ensuring that their financial decisions comply with applicable laws and regulations. Mentions of specific financial products or services do not constitute endorsements. Perform your due diligence before engaging with any financial offering. Listeners are fully responsible for their financial decisions, and the podcast's guests, hosts, and affiliated entities are not liable for any financial losses resulting from actions taken based on the provided contents.